Welcome to Safe Money Retirement Radio with your host, Tim Wood. Tim is a certified financial fiduciary and a no-market risk retirement and income specialist, and the owner of SafeMoneyRetirement.com, primarily serving Western North Carolina, East Tennessee, and Southwest Virginia. But he's sought after nationally for his expertise in helping people secure their retirements. Mr. Wood is a licensed life insurance professional in multiple states and specializes in working with people who are near retirement and those who have already retired with wealth management, income planning, and asset protection strategies. And now, here to talk with you about no market risk retirement planning, your host, Tim Wood.
Welcome to Safe Money Retirement Radio. I'm Tim Wood, an asset and retirement protection specialist. I'm going to start this segment off with an interesting question. What are mortality credits? Have you heard of them? Do you know what they are? There's something very important that you need to know in reference to your retirement. So we're going to talk about what mortality credits are today and how they can work for you. First, if you don't already have a copy of my book, Safe Money Retirement, Your Game Plan for Success, I've got a whole section in there that talks about mortality credits and what they are and how they work. You can get your copy absolutely free. Just give us a call, 844-905-SAFE. We'll send you a copy, no cost or obligation. Again, 844-905-7233. All right, so let's answer that question. What are mortality credits? At its most basic, a mortality credit is nothing more than money left over when an annuity owner passes away earlier than expected. A mortality credit is created when that person doesn't receive the income payments that they would have obtained if they had lived to their life expectancy. My friend Tom Hegna, that does a lot of webinars and I send out his books, he has a story that he tells, and he basically says it this way. Here's how he explains mortality credits. There are 5 women that decide to go to the beach. While they're at the beach, they each decide to put $100 into a jar, close it up, and then the next year they would go again, and whoever was still alive, they'd split the $100. Well, of course, there's 5 of them. They put 100 in there, or they each put 100 in there, so there's 500. The next year they go. Unfortunately, one of the women have died. So now the other 4 get to share the whole $500. That's a 20% return on their $100 each. Now, was that in the market? Did they invest it at all? No. That's a mortality credit. That's how mortality credits work. So let's go one more level. They do it one more year. The next year, another lady is gone. So now there's only 3 left. And they decide the same thing. Let's go ahead and let's let it ride to the next year. But if they wanted to take the money out, the 3 of them would then be splitting $500, which would be a 40% gain in 2 years. Again, they go one more year. They wind up just splitting. There's only 2 people left now, 2 ladies left. They each split the $500. They each get $250 out of just putting $100 in. How is that possible? Mortality credits. The leftover money is put into a pool of funds from other contract holders where the pool will pay lifetime income to those who do live beyond their life expectancy. So in this sense, mortality credits are used by the life insurance company basically for pooling longevity risk across tens of thousands of people. Sometimes they're called actually mortality yields, as that name indicates how they might impact annuity returns. Now, real quick, I just want to talk about how an annuity actually works. But if you haven't already got a copy of my book, Safe Money Retirement, Your Game Plan for Success, you're missing out. I go into a lot of this in more depth. Give us a call now, 844-905-SAFE, and we will send you a copy absolutely free. The first basic definition of an annuity that you need to know, an annuity is nothing more than a contract with a life insurance company. That's all an annuity is. Now, there are a ton of different quote-unquote flavors of annuities, and if you've read my book, You read that I say I wouldn't touch probably about 90% of them with a 10-foot pole. There are a lot of them I do not like, but there are some obviously that are really good for what they're going to do, depending on what you need done. But let's talk about how an annuity itself works. Basically, there are 4 parties to an annuity contract. So party number 1, the issuer. That's the life insurance company. They create and they issue the annuity. This is the party that receives and holds the money to purchase the annuity. So that's the company that you would actually be getting the annuity from. Again, you've got to make sure you're only dealing with the top-rated companies. The second part of an annuity is the owner. That's you. That's the purchase who purchases the annuity from the insurance company. That's the owner of the annuity. Very simple. There's not really much more to say about that. The next person in an annuity is actually the annuitant. A lot of people get that confused. And is the annuitant always the owner? Is the owner always the annuitant? The answer is no. They do not have to be the same. In a lot of cases, they are, but they do not have to be. I can give you several different stories, and I've actually got one in the 9th chapter of my book that talks about a lady who was the owner, and she made her son the annuitant because she wanted to make sure the funds went to him directly as soon as she passed, because there were family issues. But here's the deal. An annuitant is someone whose life is used to determine the timing and amount of the benefit payments to be made. Now, again, it's usually, but it's not always the owner. It can be someone else, but that's all the annuitant is. That's the person whose life we are using to determine the timing and amount of the benefit payment. And then the last person in an annuity is the beneficiary, and it can be more than one, and there are primary and then secondary beneficiaries. And I always recommend my clients to do, obviously you've got to do a primary, always do a secondary just in case something happens to you in that primary at the same time or whatever, so this money can go to somebody. But basically the beneficiary, that's the individual who will receive any death benefit available when the annuitant dies. So between those 4 different parts of an annuity, that's how an annuity is built. Now, there are a bunch of different types of annuities, as you've heard me talk about. There are guaranteed lifetime income annuities. There are annuities that are called MIGAs, multi-year guaranteed annuities that work like CDs that have specific terms. There are fixed indexed annuities that allow you to get growth based on an external index. Or in some cases, there are some products out there that are kind of hybrid products that allow you to choose every year between an external index and a fixed rate. So it really depends on exactly your specific situation. And that's why I have everyone start the process with me doing a fact finder appointment. In the fact finder appointment, we're not going to talk about companies. We're not going to talk about rates. We're not going to talk about any of that stuff. We're going to talk about you. What's your situation? Where are you at? What do you need to accomplish in order to make the growth that you want or the income that you want or whatever? Let's determine what that is and figure out how we can get you that on a guaranteed basis. Again, if you don't have a copy of my book, please give us a call and let us send you one. It will answer a lot of your questions and help you plan for your own safe money retirement. The number again, 844-905-SAFE. Ask for a copy of my book, Safe Money Retirement, Your Game Plan for Success, when you call. Again, the number is 844-905-7233. Well, I'm about out of time, and I would like to thank you for listening to Safe Money Retirement Radio. If you're serious about your financial future, give me a call, and together we'll get your retirement savings on the fast track to accumulate while reducing exposure to market risk. Thanks for listening, and until next time at the same time, I'm Tim Wood, reminding you to stay safe so you can step into a secure future.
You've been listening to Safe Money Retirement Radio with your host, Tim Wood. Find out how to guarantee that your hard-earned money is safe with locked-in returns that will never go down due to market risk, so you can have the future that you deserve. Call Tim Wood now for your free copy of his #1 best-selling book, Safe Money Retirement, Your Game Plan for Success, along with the free Safe Money Retirement Information Kit at 844-905-SAFE. That's 844-905-7233. Or visit him online for more details at safemoneyretirement.com. The preceding information does not represent tax, legal, or investment advice. Surrender charges apply to base contracts. Optional lifetime income benefit riders are used to calculate lifetime payments only and are not available for cash surrender or in a death benefit unless specified in the annuity contract. Fees may apply. Guarantees are based on the financial strength and claims-paying ability of the insurance company. No information presented today should be acted upon without meeting with a qualified and licensed professional. Obviously, by calling us now, you are just taking the first step towards protecting your retirement. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Rates and returns mentioned on this program are subject to change without notice.